I'm here to talk about ISAs and how we can potentially make them exempt from inheritance tax. The first thing I want to make clear is that ISAs are not ordinarily exempt from inheritance tax. We've already covered the different types of ISAs you can hold, including cash and stocks and shares ISAs. For the ISA to be inheritance tax exempt, the investment must qualify for business relief. One of the investments you can own to obtain business relief is trading company shares listed on the alternative investment market, or AIM. Shares must be held directly for a minimum period of 2 years to qualify. Therefore, by converting existing cash or stocks and shares ISAs into a qualifying AIM portfolio, the value can become exempt of inheritance tax charges. An alternative approach to using ISAs as part of an inheritance tax strategy is to generate additional income, which can be used for gifting purposes. When gifting, the excess income not required for your own needs can fall outside of your estate immediately without triggering the 7-year rule normally associated with gifts. Naturally, professional advice is required here to ensure clarity on what qualifies as excess income. Following on from the above principle, another solution is to take out a life policy, known as a whole of life plan. This can pay out a tax-free lump sum to your beneficiaries, paying some or all of the liability due. Where this dovetails into your ISAs is the premiums for this policy could be paid in part or in full by generating additional income when needed from your ISA portfolio. We hope you enjoyed our series of ISA emails and videos. If you have any questions or would like to discuss any of your ISA planning, please contact your Mattioli Woods consultant. As with all investments, capital is at risk, and we always recommend you speak to your financial advisor for further advice. With ISAs, rules apply and can change.